I'm talking about a credit risk. It's basically the possibility of a loss for a company or for an investor because of the borrower. Any lender is exposed to a credit risk where the borrower of that particular lender is not making a timely payment of the interest and principal. Whenever the interest and the principal has fallen due, the timely payment of that is not done. That is where we say that the lender is exposed to credit risk. And more broadly, we look at this coming out as two components. One is called as a default risk, which is more associated with the probability that the borrower is not able to meet the obligations on time. And the second one is the loss severity, or more common word for this is LGD, loss given default. In case the borrower has defaulted, what is the amount of loss? What is the money that would be typically lost? So it could be expressed either in dollar terms or in percentage of the loan amount or percentage of the bond value. So what percentage is really lost? Because there is some possibility of recovery, because we know that every bond that is issued, in some cases there could be a collateral, so that collateral can very well be sold off to recover something. Even if it is an unsecured kind of a bond, if it is a secured kind of a bond, there is some amount of collateral for this. If it is unsecured also, there is a general claim on the assets of the company. So those assets can very well be sold off and some amount can be recovered. It's not that 100% that is lost. So every time we look at the credit risk of any particular company exposed to any particular borrower, we look at these two dimensions. One is the default risk arising from the probability of failing to pay. Then the second one is the severity, which is associated with the amount that is typically lost. In general, the multiplication of these two is sometimes called as expected loss. Expected loss is nothing but it is the default risk multiplied by the loss given default. So again, this could be expressed in percentage terms or it could be in dollar terms. And generally, whenever we are talking about the expected loss, it means that on an average, the loss for the company because of the default is going to be this much. So in reality, it could be much more than that or it could be much lesser than that. And whenever we are using another term called recovery rate, it is more and more closely related to your loss severity. In loss severity or loss given default, if I am expressing it in the percentage terms, 1 minus of that is what is the recovery rate, right? So this is what is a very basic overview of this credit risk. And what we typically see is if the credit risk is high, obviously the chances of default are higher. So who would be interested in investing in those kind of securities? So because of that reason, if the credit risk is higher, it is expected that those kind of securities should give high return, which means the yields on those kind of securities which are having a credit risk, higher credit risk, they need to be much higher. Typically, we see that the government securities, which are the treasury bills, treasury bonds, they are considered as risk free. Whereas the corporate bonds, they are having some amount of risk. So the risk that is the return that is expected on the corporate bonds is looked at from this particular perspective: risk-free rate, which is the treasury bond rate, plus some kind of a premium on the top of it to typically account for this additional risk that is coming up. Right? To account for this additional risk, there is an additional return that is expected, which is otherwise called as the yield spread. So the spread will be higher and higher if the credit risk is higher, and so the larger is the spread, the larger is and the higher is an indication of the credit risk associated with that particular security, right? So the higher is the credit risk, right? One more relation: credit risk is higher means yield spread is higher. So overall yield could be higher. Overall yield is higher means bond prices are lower, because we have already talked about the prices and yields following a negative relation. So here also we can very well bring out that there is a negative relationship that exists between the yield spread and the bond prices. As the yield spreads are increasing, the bond prices are decreasing, and vice versa. And we have also talked about the size of the spread. The higher is the spread, the higher is the risk associated, the lower should be the bond price. So this is where we talk about the spread risk. Even the spread need not be constant. The spread could widen in some cases, or it could narrow also. So the risk that the spread can change, and because of that loss can come up, is more and more associated with the spread risk. Obviously, if the spread is narrowing, it is becoming more and more secured, safer. But only if the spread is widening, the credit risk is actually growing higher. And the spread is widening can very well be assessed from these two dimensions. There is a credit migration that is happening, which could very well result in downgradation of the company. The credit got migrated because of the change in the macroeconomic scenario, or in the way the company is working, or in the industry related scenario. So because of any of these things, the credit worthiness of the company has typically changed. It might have downgraded. The credit worthiness of the company has gone down during the period, which is what is the job that is taken by the credit rating agencies. We know that there are widely popular credit rating agencies like S&P, Moody, Fitch. They do provide different kinds of credit ratings for the different securities. So there might be a possibility that by assessing the financial condition of the company, the credit ratings might have been downgraded, or there might be a possibility of the market liquidity itself overall within the market. The cash is going more and more squeezed, and because of which I am not able to sell the asset at the market price. If at all I have to sell off the asset, I have to compromise on the price. So this is what we are calling as the market liquidity. Even that liquidity risk coming up is widening the credit spread. So the spread is getting widened either because of the downgradation, or because of the market liquidity getting crushed up, which is resulting in a widening of the spread, which is again resulting in lessening of the bond prices across. So these relationships should be comfortable, should be something which we need to be comfortable with. And regarding the structure, every company, the debt structure, there might be different kinds of debt associated. So we can categorize them under secured or unsecured. The ones which have collateral with them, we call them as secured. For those ones, they have a general claim on all the assets, no specific claim on a particular asset. We call them as unsecured. Unsecured debt are typically the debentures. So the priority wise, this group will have a higher priority in terms of settlement when the company is typically going bankrupt or typically getting winded up, liquidated. So only after the payment of all these secured investors, the payments start flowing in for the unsecured ones. Again, in this we could see there could be something called as a first lien or senior secured or junior secured. So all of them, again, the priorities internally could change. The first lien is the one who gets the first priority in case of liquidation. Then the senior secured category, probably there could be some intermediately secured between a senior and a junior, and probably we are getting finally the junior secured or subordinated is what we call. So the order of flow is like this, and similarly we can create a kind of a structure here also. Senior, junior, subordinated. Again, the sequence in terms of the payments go completely in this way. So the seniors are getting the settlements first, then followed by juniors and subordinated. And what we typically see is all the bonds that are falling in one single category, they are treated equally. Right? At least there would not be any kind of a differentiation in case of settlement during a corporate bankruptcy that is happening. And obviously, whatever is recovered first goes to the seniors, which means the priority in terms of settlement is higher for them, which means credit risk is generally much lower for that senior debt compared to the subordinated debt. Right? So as the seniority is going down and down, probably the priorities are going down and down, which is resulting in credit risk typically going up. It might very well be possible that only the senior and senior secured, junior secured, and probably senior unsecured are getting the proceed, and it might very well happen the junior unsecured and subordinated debt may not get any kind of proceeds also. So the risk is much higher with the junior, unsecured and subordinated kind of debts. But in some cases, what we typically see in reality is, though the structure is fair enough, senior secured, junior secured, senior unsecured, junior unsecured, subordinated. So after the full settlement happens to this, the settlement comes here, then the settlement comes here, and in case only a little bit is left, it goes to this. They have these guys remaining is not paid to them, and these set of investors may not receive anything. That is theoretically, but in reality what could happen is some small payment, some amounts could be paid even to these guys, even to these investors, even if they are not paid in full. Probably 90% could be paid to them, 80% could be paid to them, 30% could be paid to these set of investors. Sometimes this kind of a reorganization can very well happen. Though theoretically we talk about it's a waterfall kind of a structure, in reality there could be some kind of a reorganization, because what we see is the bankruptcy settlement typically takes long amount of time, and even there is a cost that is involved in it. So because of this, all the classes who are planning to lose, they come out with a kind of a reorganization plan, which may not be in strict line with the priority of the claims. So this is where some small structural difference can very well come up, and some kind of a deviation from the theoretical structure is very likely to follow. Right? Now, when I look at the credit ratings that are typically assigned by the traditional rating agencies, important things that I need to look at is they majorly focus on the credit risk of the company, and all the companies which are more or less similar from the dimension of the credit risk, they are rated, they are given a similar kind of a rating. Now here there are two kinds of ratings which we need to carefully look at. One is a issuer based rating, the other is